Well, Disney has announced it will make a cash dividend payment, a return of its dividend to shareholders. And this is happening for the first time since January 2020. The company suspended the dividend during COVID-19, while the media giant will be making the payment of 30 cents a share to shareholders in January of next year. Now, this comes after Nelson Peltz's Trian Fund Management is moving ahead with a proxy fight at Disney. The activist hedge fund saying in a press release on Thursday morning that Disney extended an offer to Trian to meet with the board, but turned down its recent request for representation, including for Peltz himself. For more on Disney's battle with Peltz, we're joined by Doug Creutz. He is a TD Cowen's Managing Director of Media and Entertainment. Doug, it's great to see you here. So I'd love first just your your viewpoint on this return of the dividend and this pressure that Iger continues to remain under here from Nelson Peltz, whether or not maybe some of the moves that we have seen or decisions announced in the last couple of days, that's really going to do anything to change some of the mood and sentiment around Disney stock.
Yeah, they had previously announced that they were going to institute a dividend, and they did. You know, their cash position is much better than it was in sort of the depths of the pandemic when the parks were shut down. So there was, no good reason for them not to go back to paying a dividend. I don't think that has anything to do with Peltz. They did change some of their proxy voting rules as well. That is a little bit more of a reaction to Peltz. I think in general, though, I don't know that they feel a lot of pressure from Peltz. He can make noise, but at the end of the day, I think he has less than 2% of the vote. I don't think shareholders in general, while maybe some of the shine has come off of Bob Iger in his second stint, I don't think shareholders really want to see him go, and I don't think in general they think that Peltz has anything to add to the conversation.
Okay, and so of these activist campaigns, what should investors then continue to expect? What kind of weight do you think that they'll continue to give them, as Disney right now really has just kind of bounced off of some of those lows? And of course, we've seen it be able to move to the upside with some of the broader market activity over the past month in November. But at the same time, it's still a ways off of where the company had been in some of its year-to-date highs.
Yeah, Iger came back. He cut a lot of costs out of the business. And now he's sort of identified the need for Disney's content engines to start being successful again. They've had a very soft run at the box office post-pandemic after having had an incredibly strong run pre-pandemic. Some of that's just reversion to the mean, but I think that there's been some specific issues at some of the studios that he needs to address in the two plus years that he has remaining to get them back on better creative footing. And again, I don't think external activists have anything to add to that.
Doug, when it comes to some of the headlines that Bob made at New York Times' DealBook Summit earlier this week, he talked about some of the discussions around the TV side of the business, whether or not those assets he views as valuable here for the company, kind of turning around and saying that, hey, he thinks it actually makes sense for Disney to hold on to these assets. Is that something that you think is critical when you look at the future of Disney and what this company is going to look like 5-10 years from now?
Yeah, he's kind of gone back and forth on it a bit. I think his current position may reflect the reality that even if he wanted to sell those assets, and I'm not sure that he does, there may not be a lot of buyers for them right now. Like, nobody really wants to invest in linear television assets right now, including general investors. Like, all these media stocks are trading at very low EBITDA multiples. The future of linear television is very much in question, at the same time as the level of profitability of streaming is also in question. And with that much uncertainty, there's just not really any reason for anyone to step up and say, oh yeah, I'll take those assets off your hands. I don't think anybody would really think they could run them so much better than Disney's run them that they could, squeeze extra profitability. So I think right now, whatever he feels inside, he's stuck with the assets and he has to do the best with them that he can.
He's also going to have to figure out when this company is going to start communicating to the streets, to some of the investors, as well as those who just cover this company, what new leadership can look like. And at that DealBook Summit also talked about and confirmed that the succession process that I believe he said is very robust right now and looking to retire at the end of his contract in 2026. Something that we have heard and discussed time and time again. But is there a front runner at this point that's started to come to light from your perspective, Doug?
Yeah, I feel like we've been talking about Bob Iger's succession plan for 10 years now because we have. Look, I think generally up until a few months ago, I would have said they're almost certainly going to pick someone internal. And, the list of names internally isn't super long. But I thought it was very interesting. They had to replace Christine McCarthy as CFO, and they hired the CFO from Pepsi away, and brought him in to now fill that job.
Right here.
That was the first external hire of a senior C-level executive that they'd made in almost 30 years. And that was an interesting signal, I thought. I don't know that means that they're willing to consider an external candidate. I still think Disney is a company with an incredibly strong and unique culture, and having someone come from the outside, it entails a lot of risk to that. But they may be more open to it now than they were before. And if that's the case, then, the potential list of people is really long. There's plenty of people who would love to be CEO of Disney. It's just a question of who the board thinks can do the job.
Doug, while we have you, we also want to get your thoughts on a headline that broke this morning. It was a report from the Wall Street Journal saying that Apple and Paramount are in discussions about bundling their streaming services. I know you cover Paramount. Is this a strategy that you think makes sense?
Yeah, look, I think in general, if we're talking about the future of these companies, the best case scenario would be that we essentially reconstitute the old cable bundle where everyone's networks are contained in one product, using all the streaming services. I think it'd be better for consumers because they would easily be able to get all the content they want in one place. It's better for the companies because then they don't have to worry as much about user acquisition. And, it also allows people like Apple to promote their own streaming services, not as a standalone product. So I think it makes a lot of sense. And I think you're going to see more of this. I think really it's the only way out of this bind that media has found itself in, is to reconstitute the bundle. I don't know how long it's going to take. It's going to be kind of like herding cats, I think, with all the various personalities and companies involved. But I think this is probably the start of a trend. Yeah.
Yeah. All right. A lot to continue to track there. Doug, thanks so much for kicking off the trading session and a new trading month with us here on Yahoo Finance. TD Cowen, Managing Director of Media and Entertainment. Appreciate it.